A warm welcome to our monthly market update. My name is Colin Beveridge, Chief Investment Officer at True Potential. Now, over the previous month, investors have witnessed equity markets in the US hitting new all-time highs. Share prices are being helped along by strong job creation, moderate inflation, a weaker dollar boosting US exports, and rising US corporate profits. Good news on this scale has not been confined to the US. Europe is beginning to show improvements in its economic performance. Confidence is improving, with economic sentiment rising to a decade high on the back of increased optimism around services and construction. Now, although economies and riskier assets are performing well, the media continues to focus on potential for bad news. One area facing challenges is fixed income investing. Investors owning bonds are grappling with inflation expectations moving up and down and trying to judge the mood of central bankers who set interest rates. Now, since December 2016, we have seen 3/4-point interest rate increases in the US. This has been a restraining factor for bond prices, with yields pushing up in some areas, but interestingly, it has not restrained equity markets. Despite all the media warnings that interest rate increases would require equities to fall, share prices globally have in fact continued to rise. Looking ahead, investors anticipate that central banks in the US, Japan, Europe, and in the UK will act with caution. If interest rates need to rise, it will be gradual, keeping monetary conditions supportive for investors. As advocates of diversification, a key advantage we believe it offers investors is the option to tune out of market noise around growth, inflation, interest rates, and currency, accepting that some areas will be doing better, others worse. As I have said, this is true right now for bonds versus equities. Presently, our investment partners are more inclined to hold bonds for defensive reasons rather than for their yield attractions, which are diminished relative to history. However, bonds within a multi-asset portfolio can protect against the possibility of dislocation in the global economy and act as a shield against unexpected negative events. Tactically speaking, our manager partners have been lowering bond duration, which in simple terms means they are lowering portfolio sensitivity to interest rate hikes. If bond yields continue to rise, short duration portfolios maturing earlier will be in a better position to reinvest on more favourable yield terms. Meantime, from our table of market returns, you can see equities over the month producing strong returns, led by emerging market equities. One area where we have seen high volatility and poor returns is in commodities, and in particular, the oil price. Although the oil price has bounced by around 6% over the month, helped by Saudi Arabia saying they're committed to dealing with the global oil supply glut, the price is still down 16% this year. The ability, or perhaps more correctly, the inability to control supply is causing many headaches for the oil industry. However, in these circumstances, stock picker managers can selectively navigate areas around areas like the oil sector, where powerful downtrends are evident. Our investment philosophy is to benefit from both active stock picking and from passive tracking of an index, which lowers costs. Finally, a word on currency. Sterling's depreciation since Brexit has boosted the value of overseas investments. Last month, sterling appreciated against the dollar, but weakened against the euro, demonstrating that sterling can get caught up in crossfire played out across global currency markets. Currently, the market mood is positive on European economic recovery and a little bit more negative on the lack of a Trump boost to economic growth in the US. But of course, this can change. Our portfolio currency positioning varies, reflecting the different approaches of our managers. For example, 2 are fully hedged against sterling strengthening, one is half hedged, and the remainder are strategically hedged depending on strength of their view. We believe this is a further example of our highly diversified approach. Advanced diversification is aligned with downside management, but it also takes aim at a wide opportunity set to capture upside potential. Thank you for listening.